Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of January, with analysts predicting that we would see little change from the month of December. We got our answer at 8:30 this morning when inflation did indeed accelerate, coming in at 1.9%, with, even more importantly, measures of core inflation, those measures the Bank of Canada cares about, accelerating as well. Yeah, the central bank definitely isn't going to be pleased about this news, and that's even with the GST holiday pulling down the rate of inflation. Yet, the accelerating inflation data comes as the Bank of Canada is not so much worried about inflation. As its recently released summary of deliberations show, the focus has shifted towards the economy, on the potential fallout of a trade war with the United States. And to add to the complications facing the Bank of Canada, U.S. inflation also came in hotter than expected last week, raising the chances that the Federal Reserve is going to have to raise rates this year, with even Fed Chair Powell acknowledging last week that the Federal Reserve has more work to do. And all of this put together, rising inflationary pressures coming out of the United States along with a weakening economy here, and, as we'll see today, accelerating inflation, presents a significant challenge for the Bank of Canada. So what I want to do today is go over Canada's inflation data for the month of January, take a look at the challenges facing our central bank, and then discuss some implications. As we'll see today, we are seeing some upward trends in inflation while the economy continues to weaken, and the central bank grows increasingly concerned. We will obviously continue to track how all of this plays out on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. Onto the data. First off, as mentioned, Canada's inflation rate came in at 1.9%.
Nothing to worry about.
Well, let's take a look. StatsCan readily admits that said inflation data was pulled down by the GST holiday, with food from restaurants declining by 5.1%. And as for the major contributors pushing prices up, we have gas, telephone, cars, fruit, and natural gas, whereas air travel, food from restaurants, travel tours, traveler accommodation, and alcohol are pushing prices down. So all of the things that you need to leave the country, both figuratively and literally, are getting less expensive, whereas the things that you need to stay, gas, food, telephone, communications, etc., are getting more expensive.
You can leave.
And finally, as mentioned, measures of core inflation, those measures that strip out the more volatile items like food and gas, and those measures the Bank of Canada looks to when deciding interest rate policy, are showing some stickiness as well, with CPI median going up from 2.6 to 2.7 and CPI trim up from 2.5 to 2.7 as well. And these measures have been showing some month-over-month stickiness ever since September, where we can see them coming in consistently over 0.2%. Meaning the closer we get to next year, more and more these measures are going to start to look even more problematic. So we have inflation picking up a bit of steam, though it doesn't really show it as it is being artificially pulled down by the GST holiday, and we have underlying measures of core inflation showing some stickiness as well. Definitely not great news for the central bank. And while Canada's inflation data is of no doubt growing concern for the Bank of Canada, of even greater concern is the uncertainty emanating out of the United States, as demonstrated in the Bank of Canada's summary of deliberations. When the Bank of Canada met last month and ultimately decided to cut interest rates, it stressed that prolonged economic uncertainty, meaning the threat of tariffs, were a major downside risk to the economy, discussing the issue at great length. And the bank stressed that even if those tariffs do not come into effect, if they don't materialize, just the threat of said tariffs and the uncertainty surrounding them were enough to damage business investment, with the bank noting that firms were already considering shifting investment to the United States, which would obviously have some real negative impacts here at home in terms of hiring, income, and household spending.
If you considered a reverse mortgage?
And it was this worry, not just the trade war, but the economic uncertainty surrounding the discussion of the trade war, that led the Bank of Canada to cut rates last month. And even with the inflation worries that we saw today, it's very possible that the bank is not done yet, with Doug Porter of the Bank of Montreal noting that it will be the trade war and not inflation that will be the dominant factor the bank will weigh in deciding its next interest rate decision in March, with the assumption being that the bank will continue to shave rates down slowly. which, yeah, that is definitely possible, though I think if we do see those 25% tariffs at the beginning of March, especially if they're stacked on top of the aluminum and steel tariffs, then I don't think the bank is going to shave. I think it's going to cut, and it's going to cut aggressively. But as we talked about before, I'm still of the opinion that those 25% tariffs are not going to materialize, as the underlying arguments don't make any sense. This is a power play consistent with negotiating tactics, potential U.S. economic damage, short-term inflationary pressures, Canada becoming the 51st state won't happen in time for Trump to get the credit, etc., etc., etc. Regardless, though, while the bank may be undergoing a rate-cutting trajectory, it's not as simple as tariffs come and rates go to the floor.
Yes, it is.
Recent data coming out of the United States shows that managing the economy through these times is going to be an increasingly complicated endeavor for the Bank of Canada, as U.S. inflation just came in at 0.5% in January alone. And that 0.5% increase comes after a 0.4% increase the previous month and a 0.3% increase in November, with U.S. CPI now sitting at a 7-month high of 3%, raising concerns that the Federal Reserve will have to raise rates this year. Which, of course, isn't great news for the Bank of Canada, and not just because of the currency differentials that we've discussed before on this channel, though that is definitely a concern with the value of the Canadian dollar already showing signs that Canada is importing inflation. But rather, in addition to those currency problems, as noted by David Rosenberg, if the Federal Reserve continues to remain tight, if the Fed does have to raise rates, then that higher cost of borrowing is going to trickle down into the bond market, into bond yields, and thus into mortgage rates. That upward pressure on bond yields and thus mortgage rates is going to blunt any effort from the Bank of Canada to loosen financial conditions, meaning it's going to blunt any effort from the central bank to make it easier to borrow. Meaning, as we've been talking about on this channel for at least the past year, probably the past few years, the central bank can cut rates all it wants. It will be conditions coming out of the United States that dictate what the cost of borrowing is.
I can't do a thing about it.
Yeah, pretty much. The Bank of Canada could very well find itself in a position where it's having a difficult time getting financial conditions loose enough to stimulate the economy, while the Federal Reserve remains tight in the United States, something we really haven't seen since the 1990s. Back then, we had a spread of about 2.25% between the Bank of Canada's rate and that of the federal funds rate. Meanwhile, the yield on the 5-year Canadian government bond was running lockstep with that of the 10-year U.S. Treasury. So, it is very well possible that the bank could find itself in a spot where it's not able to get interest rates any lower to stimulate the economy, absent, of course, quantitative easing, which, if the Fed isn't also doing QE, that could very well cause a lot of problems with our currency, though that's a video for another time. But the bank could find itself in a spot where it's not able to lower interest rates, even if it wanted to, as inflationary pressures from the United States are keeping fixed rates higher, and even at that point, the Bank of Canada might not want to, as our own inflation is starting to pop back up.
This is a nightmare.
So, on the one hand, we have pressures coming out of the United States pushing up inflation, which I think we are seeing show up in the data. On the other hand, we have pressure coming from the United States pushing down our economy, which the Bank of Canada has shown in its summary of deliberations is very much on its mind. If these two pressures continue, don't be surprised if we start to see more and more articles emerging discussing stagflation. That is, low growth with high inflation, seriously complicating the Bank of Canada's job. How this all plays out definitely remains to be seen, but we will obviously continue to track Bank of Canada actions to deal with this inflation and the economy on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.